Welcome to Investing for Beginners, the smartest money move of your life and one of the easiest to start. By the end of this video, you'll know exactly how to start investing. Here's the exciting part. You don't need to be rich or an expert to learn the basics of investing. With just a small amount and a few simple foundations, your money can start working for you. That's how ordinary people build wealth and reach financial freedom. By starting early and investing consistently. And the best time to start investing is today. This beginner's guide breaks it all down. No jargon, no confusion. So stick with me because this could be the video that sets up your financial future. Let's get into it. Let's start with the basics. Investing means putting your money to work so it can grow over time. That's it. When you save money in a regular bank account, it mostly just sits there. Safe still, but barely growing. When you invest, you're buying assets, things that have the potential to increase in value or pay you income. Here's the key distinction people miss. Saving and investing are not the same thing. Saving is for safety and short-term needs. Money you can grab at a moment's notice. Investing is for growth over the long term. Both matter, but they do different jobs. And confusing the two is where a lot of people go wrong. So why bother investing at all? One word: inflation. Every year, prices rise. The money sitting in your account today buys less next year. If your cash isn't growing, it's quietly shrinking in real terms. Think about it. A loaf of bread that cost a few dollars a decade ago costs noticeably more today. Your savings need to at least keep pace with that. Investing is how you stay ahead of that erosion, and ideally, build real wealth. And the engine that makes it all work? Something called compound growth. Let me show you why that's the most important concept you'll learn today. Compounding is when your money earns returns, and then those returns earn returns of their own. It's a snowball effect. Here's a simple example. Say you invest $1,000 and it grows 8% in a year. Now you have $1,080. The next year, you don't just earn 8% on your original 1,000, you earn it on the full 1,080. And it keeps building from there. Year after year, you're earning returns on top of your previous returns. In the early years, this feels slow, almost boring. You might invest for 2 or 3 years and think, is this even worth it? But give it time, and the curve goes vertical. The growth in the later years dwarfs everything that came before. Someone who invests a modest amount in their 20s can end up with more than someone who invests far more in their 40s. The difference isn't the amount, it's the time. Let me make that concrete. Imagine 2 people. One starts investing a small amount at 25 and stops at 35, just 10 years of contributions. The other waits, starts at 35, and invests that same amount every year until they're 65. 30 years of contributions. In many scenarios, the person who started earlier and stopped still comes out ahead, despite contributing for a third of the time. That's how powerful those early years are. This is why the single most powerful move you can make is to start early, even if it's small. Time in the market beats timing the market. So the lesson is simple. Don't wait until you have enough. Start with what you have, and let time do the heavy lifting. Before you invest a single dollar, you need a stable base. Investing on a shaky foundation is like building a house on sand, so here are the 3 things to handle first. Number 1, an emergency fund. This is cash set aside, typically 3 to 6 months of living expenses, kept somewhere safe and accessible. Why? Because life happens. If your car breaks down or you lose your job, you don't want to be forced to sell your investments at a bad time, possibly at a loss. The emergency fund protects your investments from your emergencies. It's the buffer that lets you stay invested when life gets bumpy. Number 2, high-interest debt. If you're carrying credit card debt charging you 20% or more, paying that off is effectively a guaranteed return that beats almost any investment. Think about it. If an investment might earn you 8%, but your debt is costing you 20%, clearing that debt is the smarter move every time. Clear the expensive debt first. It's the best investment you can make. Number 3, know your goals and timeline. Money you'll need in 2 years should be treated very differently from money you won't touch for 30. Short-term money stays safe. Long-term money can afford to grow and ride out the ups and downs. Ask yourself, what am I investing for, and when will I need this money? Your answers shape every decision that follows. Once these 3 are in place, you're ready to actually invest. Now let's talk about what you can actually invest in. There are a few core building blocks. You don't need to know all of them to start, but you should understand the basics. First, stocks. A stock is a small piece of ownership in a company. When you buy one, you literally own a sliver of that business. When the company does well, your share can rise in value. And some stocks also pay you a portion of the profits. That's called a dividend. Stocks offer the highest growth potential over the long term. But there's a trade-off. They also swing up and down more in the short term. That volatility is the price you pay for that growth. Second, bonds. A bond is essentially a loan you give to a government or to a company. In return, they pay you interest over time and eventually pay back what you lent. Bonds are generally steadier and less risky than stocks, but they also grow more slowly. Think of bonds as the calmer counterweight in a portfolio. They're the part that holds steadier when stocks get turbulent, the ballast that keeps things balanced. Third, and this is the one most beginners should really pay attention to, funds. Specifically, index funds and ETFs. Here's why they matter. Instead of buying a single company's stock, a fund lets you buy a tiny slice of hundreds or even thousands of companies, all at once. An index fund that tracks the whole market means that when the overall market grows, so does your money. And for most people, that simple approach quietly beats the experts over time. Now, there are other assets out there too. Real estate. Then commodities, like gold. A classic store of value people turn to when they want something solid. And newer things, like crypto, exciting, fast-moving, and far more volatile. It can have its place, but it's not where a beginner should begin. Master the foundations first. Before you chase anything fancy or complicated, get the basics right. Because the simple approach isn't just easier, it's powerful, precisely because it's simple. A solid, steady base is what real wealth is built on. And that brings us to the next foundation. The one that protects everything, managing risk. Here's a truth no one can escape. All investing involves risk. The goal isn't to avoid risk entirely. That's impossible. The goal is to manage it intelligently. The number one tool for managing risk is diversification. You've heard the saying, "Don't put all your eggs in one basket." That's diversification in a nutshell. If you pour all your money into a single company and it fails, you're wiped out. But if your money is spread across hundreds of companies, no single failure can sink you. Some will go up, some will go down, and over time the winners tend to carry the load. This is exactly why index funds are so popular with beginners. With one purchase, you're instantly diversified across an entire market. You don't have to research individual companies or guess which one will be the next big thing. There's also your personal risk tolerance to consider, how much volatility you can stomach without panicking. Younger investors with decades ahead can generally take on more risk because they have time to recover from downturns. As you get closer to needing the money, you shift towards safer, steadier investments. This is sometimes called your asset allocation, the mix of stocks, bonds, and other assets that fits your situation. And the big mistake to avoid? Panic selling. Markets drop. It's normal, and historically it's temporary. Staying calm and staying invested is a foundation in itself. Before we get to the action steps, let me save you some pain by pointing out the traps that catch new investors. The first is trying to time the market, waiting for the perfect moment to buy. Here's the problem. Nobody can reliably predict the market, not even the professionals. Time in the market beats timing the market every time. The second is chasing hype. When everyone's buzzing about a hot stock or the latest get-rich-quick trend, that excitement is often a warning sign, not a green light. If it sounds too good to be true, it usually is. The third is checking your investments constantly. When you watch every tiny move, you feel every dip, and that emotion pushes you toward bad decisions. Investing is a long game. And the fourth is letting fees slip by unnoticed. A fund charging 2% a year instead of a fraction of a percent might not sound like much, but over decades, that gap can quietly swallow a huge chunk of your returns. Small percentages compound too, in the wrong direction. Avoid these four, and you're already ahead of most beginners. Okay, enough theory. Here's exactly how to begin. Step 1. Open an investment account. This is usually a brokerage account, or in many countries, a tax-advantaged retirement account that gives you benefits for investing long-term. Look for a reputable provider with low fees. Step 2. Speaking of fees, pay attention to them. As we just covered, high fees quietly eat your returns over decades. Low-cost index funds are popular precisely because they keep more money in your pocket. Step 3. Decide what to invest in. For most beginners, a broad, low-cost index fund is a simple, solid starting point. You don't need to pick individual winners or build something complicated. Step 4. Automate it. Set up automatic contributions, even a small amount every month. This builds the habit and takes emotion out of the equation. It's called dollar-cost averaging. You buy steadily over time, instead of trying to guess the perfect moment. Some months you'll buy high, some months low, and it averages out in your favor. Step 5. Then leave it alone. Seriously, investing is not about constant action. Once you're set up, the best thing you can often do is be patient and let compounding work. So let's bring it all together. Investing isn't about being a genius or getting lucky. It's about understanding a few solid foundations and acting on them consistently. Start early and let compounding work. Build your safety net first. Diversify to manage risk. Keep your fees low, automate your contributions, and stay patient through the ups and downs. You don't need to be perfect, you just need to start. The best day to begin was years ago. The second best day is today. So take that first step this week. And if this helped, follow Finance Physio for more and subscribe. We're here to keep your money healthy. Your future self will thank you.